This is a revision of advanced audit and assurance for the exam periods of September and December 2020. This is question 1. Briefing notes to audit engagement partner from audit manager. Subject: Cruise Group Audit Planning. Introduction. These briefing notes are prepared to assist with planning the audit of Cruise Group for the financial year ending the 30 September 2025. The notes contain an evaluation of audit risks, which should be considered in planning the group audit. The notes also recommend the audit procedures to be performed on the group's segmental disclosure of revenue. Following on, there is a discussion of the matters to be considered by PEGUs in relation to proposed additional engagement to advise management on group social and environmental information. Finally, there is a discussion of how data analytics could be used to enhance audit efficiency, effectiveness, and quality. Evaluation of audit risks. Number 1. New audit client. Number 2. Integrate and maintain costs. Number 3. Component depreciation. 4. Related party transaction. 5. Borrowing cost. 6. Operating license. 7. Revenue and profit trends. 8. On-board sales. 9. Revenue recognition. 10. Cyber security attack. New audit client. The group is a new client, a firm having been appointed 6 months ago. This gives rise to detection risks, as a firm does not have experience with the client, making it more difficult for us to detect material misstatement. However, these risks can be mitigated through rigorous audit planning, including obtaining thorough understanding the business of group. In addition, there is a risk that opening balances and comparative information may not be correct. We have no information to indicate that there is a particularly high risk. However, because the prior year figures were not audited by PEGUs code, we should plan to audit the opening balances carefully. In addition, with ISA 510 initial audit engagements opening balance to ensure that opening balance and comparative information are both free from material misstatement. Upgrade and maintain costs. The group incurs high costs in relation to upgrade and maintenance of its fleet of ships. For the Sunseeker ships, $75 million is being spent this year. This amounts to 4.2% of total assets and 92.6% of profit before tax, and is therefore material to the financial statement. There is the audit risk that costs are not appropriately distinguished between capital expenditure and operating expenditures. Upgrade costs, including costs relating to new facilities such as gyms, should be capitalized, but the maintenance cost should be expensed. This is a risk that assets are overstated and the expense is understated. If operating expenses have been appropriately capitalized, a further risk relates to depreciation expense, which will be overstated if capital expenditure is overstated. Component depreciation. IAS 16 Property, Plant and Equipment requires that each part of an item of property, plant and equipment with a cost that is significant in relation to the total cost of the item must be depreciated separately. There is a risk that ships used in use are not broken down into component parts for the purpose of determining the individual cost, useful life, and residual value of each part. For example, if significant, the gym equipment should be depreciated over 3 years, therefore requires separate consideration from other assets such as ship exterior, engine, etc. This is another risk that depreciation is not correctly determined on this component basis, meaning that the assets and their associated depreciation expense could be over or understated in value. Related party transaction. It appears that Villa Shipbuilders, which is building new Explorer cruise for the group, it appears that Villa Shipbuilders Co., which is building new Explorer cruise ships for the group, is a related party of the group. This is because Max Darko is a chairman of both the group and Villa Shipbuilder Co. According to IAS 42 related party disclosure, a related party relationship exists where a person has control, a joint control, significant influence, or is the member of the key management personnel of two reporting entities. The fact that Max Dracoson Sam is the chief executive officer of Vela Shipbuilder Co. also indicates a related parties relationship between the group and the company. IS 24 requires that where there have been transactions between related parties, there should be disclosure of the nature of related parties' relationship as well as information about the transactions and outstanding balance necessary for an understanding of the potential effect of the relation of a financial statement. There's an audit risk that necessary disclosures regarding the group's purchase of ships from Villa Shipbuilders Co. are not made in the group financial statements. The related party transactions are material by their nature, but they are also likely to be material by monetary value. The information provided does not specify how much has been paid in cash from the group to Villa Shipbuilder Co. during the year, but the amount could be significant given that the group has presumably paid any final installments on the ships which have come into use during the year, as well as initial installments on the new ships starting construction this year. Borrowing costs. The ships being constructed fall under the definition of the qualifying assets under IAS 23 borrowing cost, which defines the qualifying assets as an asset that takes a substantial period of time to get ready for its intended use or sales. This includes property, plant, and equipment during the relevant construction period, which for the ships is 3 years. IAS 23 requires that borrowing costs which are directly attributable to the acquisitions, construction, and production of the qualifying assets should be capitalized. The other risk is that interest costs have not been appropriately capitalized and instead have been treated as a finance cost, which would understate assets and understate profit for the year. The amounts involved appear to be material. The information does not state precisely when the loans were taken out, and when construction of ships commence or when they come into use by the group on completion. So it is not possible to determine exactly when capitalization of finance costs should commence and cease. However, looking at the loan of $180 million taken out for the ships currently under construction, the interest for the year would be $11.7 million, which is 14.4% of profit before tax, and therefore material to profit. Operating license. The group's operating license are material to financial statements, representing 3.1% of group total assets. It is appropriate that the licenses are recognized as intangible assets and that they are amortized according to their specific useful life. However, other risks arise due to possible impairment of some or all of these licenses, which arise from the governments having withdrawn the license in some countries where the group operates their pioneer cruises. While the license withdrawal is apparently temporary in nature, the withdrawal is an indicator of impairment, and it is possible that the operating licenses are worth nothing. So should be written down as written up in full. Management should conduct impairment review in accordance with IAS 36 impairment of assets to determine the recoverable amount of the license, and if it is less than the carrying amount, recognize impairment loss accordingly. If this does not take place, the intangible assets are likely to be overstated and profit overstated. Revenue and profit trends. Group revenue is projected to increase by 14% in the year. The segmental information shows that this overall increase can be analyzed as revenue from Sunseeker Cruise increasing by 11.1%, revenue from Explorer Cruise increasing by 5.3%, revenue from Pioneer Cruise increasing by 37.5%. The different trends for each segment could be explained by business reasons. However, there is the potential risk that revenue has been misclassified between the segments. Revenue from Explorer Cruise could be understated, while revenue from Pioneer Cruise is overstated. In particular, the projected revenue for Pioneer Cruise could be impacted by the recent withdrawal of operating license, which affects the operation of these crucial itineraries. Management may not have factors into their projections, and there is the risk that these segments' revenue is overstated. Operating profit is projected to increase by 43.6% in the year, and the profit before tax is projected to increase by 24.6% in the year. However, as discussed previously, revenue is projected to increase over by 14%, while the increased margins could be due to economies of scale. The increase in profit appears outlined with the increase in revenue and could indicate that expenses are understated and misclassified. On-board sales of food, drink, and entertainment account for approximately 15% of revenue. There's a risk that this is a reportable operating segment, but the projected operating segment information does not disclose this revenue separately. According to IFRS 8, operating segments An operating segment is a component of entity that engage in business activities from which it may earn revenues and incur expenses. Whose operating results are reviewed regularly by the entity's chief operating decision maker, and for which discrete information is available, which seems to be the case in this instance. A reportable segment exists where the segment's revenue is 10% or more of the combined revenue of all operating segments. This is a risk of incomplete disclosure of revenue by reportable segments. If on-board sales meet the definition of an operating segment and it is not disclosed in the notes to the financial statement as such. Revenue recognition. An other risk arises in relation to the timing of revenue recognition. It is appropriate that customer deposits are recognized as deferred revenue when they are received. This is in line with IFRS 15 revenue from contracts and with customers, which requires that revenue is recognized when the performance obligation is satisfied, and therefore any amounts paid to the group by customers before a group begins are not revenue and should be deferred. However, the policy of recognizing all the revenue from a ticket sale when the cruise starts may not be in line with the principle of IFRS 15 because the group is performing its obligation over time, which may be as long as a 6-week period of some cruise. This is a problem of cutoff, meaning that recognitions of all revenue at the start of the cruise could result in overstated revenue and understated liabilities. Cybersecurity attack. The recent cybersecurity attack could highlight that internal controls are deficient within the group, even though this particular problem has now been rectified or remedied. If the group internal audit team had not properly identified or responded to these cyber security risks, there could be other areas, including controls over financial reporting, which are deficient, leading to control risks. The situation could also indicate wider weakness in the group's corporate governance arrangements. For example, if the audit committee is not appropriately discharging its responsibility with regards to internal audit. In addition, the cybersecurity attack could have resulted in corrupted data or loss of data. Relating to the sales system, if customer details were integrated with the accounting system, there is a other risk that reported revenue figures are inaccurate, incomplete, or invalid. Though the issue could be confined to the sales system, it is possible that other figures could also be affected. Finally, cybersecurity incident is likely to result in some fines or penalties being levied against the group, as it seems the risk was not properly dealt with, leaving customer information vulnerable to attack. It may be necessary for the group to recognize a provision or disclosure a contingent liability depending on the likelihood of a cash payment being made and the materiality of any such payment. In accordance with IAS 37, the provision contingent liabilities and contingent assets. The related audit risk is understated liabilities and understated expenses or incomplete disclosures if any necessary liability is not recognized or disclosed, not made in the notes to financial statement. But P. Principal audit procedures to perform on the segmental information. Review financial reports sent to the highest level of management to confirm the basis of segmental information which is reported internally and confirm that this basis is used in the notes to the published financial statements. Review the group's organizational structure to confirm the identity of the chief operating decision maker. Discuss with management the means by which segmental information is reviewed by the chief operating decision maker through monthly financial reports and discussion at board meetings. Review board minutes to confirm that the segments as disclosed are used as a basis for monitoring financial performance. Discuss with management whether the on-board sales should be reported separately, given that it appears to constitute a reportable segment contributing more than 10% of the total group sales and is actively monitored. Obtain a breakdown of the revenue, example by crucialize with the individual ship to confirm that revenue has been appropriately allocated between the reportable segments. Perform analytical procedures to determine trends for each segment and discuss unusual patterns with management. Recalculate the revenue totals from the breakdown provided to confirm that they are reportable segments. Examples that they each contribute more than 10% of revenues. C. Additional service to advise management on measurement of social and environmental information. The group's request for per users code to advise management on its social and environmental reporting present ethical threats to objectivity. Providing additional non-audit services to an audit client can create several threats to the objectivity and independence of the auditor. The IESBA International Code of Ethics for Professional Accountants does not specifically discuss this type of additional engagement, so the audit firm should apply the general framework to consider whether it is appropriate to provide the service. This means that the information should evaluate the significance of the threat to independence and consider whether safeguards can reduce the threat to unacceptable. A self-review threat could arise if per users co-provide the service to the group. Some of the social and environmental information could be related to transactions or balances within the financial statement, which will be subject to audit, for example, the value of charitable donations. The self-review threat means that less scrutiny may be used in performing procedures due to over-reliance on work previously performed by the audit firm. This potentially impacts on the level of professional skepticism applied during the audit and the quality of work carried out. There could be a further self-review threat depending on whether the social environmental information will form part of the group's annual report. If this is the case, auditing is required by ISA 720, the auditor's responsibility relating to other information. To read the information included in the annual report and to consider whether there's a material inconsistency between the other information in financial statements and to also consider whether there is a material inconsistency between the other information and the auditor's knowledge obtained from the audit. This requires creates a self-review thread if members of the audit team have been involved with the additional service to provide advice on measurement of the social and environmental information. All self-interest threads can be created by the provision of non-audit service where the fee is significant enough to create actual or perceived economic dependence on the audit client. The group is willing to pay enhanced fee for this service due to its urgent nature, and while this does not necessarily create free dependency, there could be a perception that the audit firm has secured a lucrative fee income. In addition to the income from providing the audit, the group needs the work to be carried out to the tight deadline, which could impact on the scope and extent of the procedure which the firm can carry out, also impacting on the quality of work and the risks of engagement. This pressure to perform work quickly within next month could be viewed as intimidation by the client. A further ethical issue, and perhaps the most significant, is that providing advice to management, which would involve determining how social and environmental information is measured, and public could be perceived as taking on management responsibility, which is prohibited by the code. To avoid taking on management responsibility, the audit firm must be satisfied that client management makes all judgments and decisions that are the proper responsibility of management. Measures to achieve this could include ensuring that members of the group's management with appropriate skill, knowledge, and experience is designated to be responsibility for the client's decision and to oversee the service. Management oversees the work performed and evaluates the result, and management accepts responsibility for any actions arising as a result of service provided. All of these threats are hidden by the fact that the group is a listed entity, therefore a public interest entity in the terminology of the code. Other safeguards could possibly be used to reduce the threats identified to acceptable level. This may include having a team separate from the audit team, including a separate partner perform the work on the social and environmental information, and conducting a review of both the audit and additional service by the engagement quality control reviewer. The audit firm should discuss the request with the group audit committee, who ultimately will need to approve that the firm can perform the service. The corporate governance code under which the group operates may restrict or prohibit the provision of non-audit services by the audit firm in the case of listed entities. So the audit committee should consider if any such restrictions exist. Discussions should also be held regarding the new regulatory requirements. The audit firm should be clear on the reliance which will be placed on the report by the regulatory authorities, and matters such as whether an assurance report is required, and if so, who will be performing this work. In addition, there may be a specific requirements which impact on the scope of the work, for example, whether any specific KPI are required to be published. Finally, if the ethical issues can be overcome, the firm should consider whether it has the skills and competencies to provide the advice to management. This can be quite specialized work, and it is not necessarily the case that the firm will have staff with the appropriate skills available to carry out the work, especially if the work is to be carried out to a tight deadline. D.